This quarter alone, this strategy made me $416,435, or an average of $138,811 per month, and it only uses one setup and minimal trades. It's slow, it's simple, and honestly, it's a bit boring, but it works. In this video, I'm gonna break it all down. The setup I use, the exact rules I follow, and I'm also going to show you multiple examples of these trades using this strategy so that you can understand it and start using it for yourself. Let's get right into it. So before we get into the actual video itself, where I'm going to be breaking down the strategy so you guys can actually go ahead and apply it and use it yourselves. One thing that I do want to mention is that I want to be transparent with you guys and show you guys my results over the last 90 days. So this is going to be market memo. This is going to be my journal. You guys can see my results here. So since March 31st, I've had a total P&L of $416,000 with a profit factor of 1.7, which is pretty solid. And then now my win percentage in terms of my individual trades is going to be a little bit lower. It's going to be 42.4. And that's because I hit a fairly large drawdown in probably, I want to say, mid-April, that I was having a lot of trouble adjusting to more volatile market conditions and a little bit of wider stop losses. So once I was actually able to make the adjustments that I needed to make in my trading at that time, I was actually able to recuperate from that drawdown, which you guys can see here in my equity curve. And then you guys can see my equity curve go on and make new equity highs. So my win rate was a little bit lower, and my winning day percentage is higher. My winning day percentage is 71.9%, meaning that I'm winning 71% of my trading days are ending in green. And what this simply tells me when I compare these two statistics here is that typically my first or second trade of the day is going to be a loser, or was a loser at that time in those market conditions. But my third or fourth trade was a large winning trade that made back all of that loss plus more, leaving me in the green, which I really only have 28.1% red days. Now, lastly, what I want to discuss here is my win-loss ratio, my R multiple. I have a realized R multiple of a 2.31, which is pretty good as well. Again, the only problem that I really struggled with was I would take maybe a little bit of a small loss, then I'd have like a larger winning trade that would make all of that money back plus more. Obviously, there was days where I'd make 8R, 9R net, but we're looking at the overall cumulative data here over the last 90 days. So I just wanted to be transparent with you guys here, and let's move on into breaking down the strategy. Now, I'm going to be breaking down the tools and softwares that I actually use to execute the strategy itself. So in that way, you guys can also get access to the same tools and softwares. Now, there's two softwares that I actually use, which realistically, you only need one of them. But the second software is a little bit more advanced and gives me more data. So that's why I prefer them. Now, I'm also going to link down in the description PDFs as to how to set up these softwares as well, or at least set up guides. I'm not going to show you how to actually set up the softwares themselves, nor link the live data. So the very first software that you see here on my screen is going to be ATAS. ATAS offers us a lot of different tools that we could use that are all order flow based. By just simply going to the learn more section up here, you can go to templates and see all of the different templates here that ATAS actually does provide for you. So if you want big trades indicators, it'll pop up when large orders hit either the bid or the ask. Then we have the bid and ask imbalance. Then we have cluster statistics. So for me personally, I'm going to be opening up the bid and ask imbalance. So, and I could also show you guys how you can activate the footprint charts on here as well. So once I click open, I'm simply going to be looking for the symbol that I'm going to be trading, which I normally trade ES. So I'm going to be opening up ES continuous, which again, you just simply have to look for the symbol that you're going to be trading. On the top left-hand side, you're going to see the time frame. I'll just simply move it down to a 5-minute time frame. Now, another big reason as to why I use the other software is because of the tick charts. So, some people like to have tick charts. I personally use tick charts. So you could use a range bar chart here as well. well. So if you want to use like a 5 range bar chart, you can, but it just doesn't come out as clean as the other softwares that I actually use. So for the example purposes, I'm going to leave this on a 5-minute time frame. And if you guys want to actually open up the footprints themselves, all you have to do is zoom in and you can actually see the footprint clusters here on ATAS, which I'll explain what that is in a second. Now, what I'm going to be doing here as well, this is going to be the most important part. I'm going to be pulling up a volume profile. So all I'm simply going to do is head over to indicators. I'm going to type in volume, and then you're going to see shortly, I'm going to type in market, and you're going to see shortly market profile and TPO, which this is going to pull up the volume profile. Now, this is going to be the session volume profile, not the cash session. So from the open to the close of the session is what we're going to be measuring in terms of volume. Now, we're going to have a few different levels to actually look at, and I've made multiple videos about volume profile already. We're going to have our value area lows, we're going to have our value area high, our point of control, and we're also going to have low volume nodes, and we're going to have high volume nodes. What the point of control is, the point of control just simply means that this is where we've seen the most volume traded throughout the day. Now, I do want to give you guys a disclaimer is that these price levels will move with price action. If you see price action pushing higher and higher and higher, and the buyers are continuously supporting the market higher and higher and higher, you're going to see the point of control move up along with the value area high and the value area low. Now, typically at the value area high and the value area lows, where we see about 70% of the day's transactions, along with marking up the lows and the highs themselves. So I want you to think about the point of control as the most volume, the specific price where the most volume was traded throughout the day, and the value area high and the value area low are going to be other means where you actually see around 70% of the day's volume actually being traded. Now, what we also have are low volume nodes inside of the markets here. So inside of the volume profile, you have these areas where you don't see as much volume, and then you have these areas where you see a lot of volume actually being traded. So you can see that these areas are all areas of high volume. So this is going to be a high volume node, which typically acts as a level of support and resistance because there's a lot of transacting going on in this area. There's a lot of business being conducted inside of these high volume nodes, and you could see it in real time. And then we also have the low volume nodes where there just simply wasn't as much business conducted in these areas because there was an imbalance that actually caused this low volume node. Again, when I want you guys to think about consolidation, I want you guys to think about support and resistance, and I want you guys to think about accumulation, which when you see accumulation, you're going to see a lot of consolidation. And again, we have a lot of business being conducted, which a low volume node is just simply caused by a buying or a selling imbalance, which is just simply caused by aggressive buying or aggressive selling. And typically you do see price action revisit these low volume nodes to actually conduct the business in these low volume nodes. So they also can work as break and retest levels. So now that we've kind of gotten volume profile out of the way and I've broken down volume profile to you guys here really quickly, I want to break down the footprint charts for you guys before we get into the actual setup itself. So this is going to be the main footprint charting software that I use, which is going to be Sierra Charts. So what I'm going to be doing is just breaking down what all of these numbers on my screen mean. So on the left column, right, you're going to see here, you're going to see a lot of green, and you're also going to see some red. And what the numbers represent is just simply volume by price. So it was how many contracts were traded at that specific price in that cluster. This is going to be volume by price. And then typically when there's going to be a positive delta, this volume will also be green as well to really give me the difference as to where a lot of the selling is coming into the market or where a lot of the buying is coming into the market. And I just have it set up that way. So you guys could see here, there's 123 contracts traded at, I believe this is 59.83, 123 contracts. At this lower price, you could see there was 125 contracts traded, 115 contracts traded, and that's again both buying and selling. So now the middle column is going to be the actual candlestick itself. And what I want to let you guys know is that this is not a time frame. This is actually a range bar chart. So each one of these candlesticks that you see here is going to represent 20 ticks inside of the market. So if price action is consolidating within a 19, 18 tick range, a new cluster will not form until we break out of that range, which price action and the data itself is more important than the time, which when you actually start to use a range bar chart with your footprint charts, you're going to see a huge difference, and the data is presented a lot cleaner as well. So this is going to be a 20 tick range bar chart or a 5 range bar chart, and this is also going to be a little bit of a higher time frame. It's going to be a 32 tick or an 8 range bar chart. Now, this is going to be the actual cluster itself. This is the candlestick that you can see that was formulated here. And then on the right-hand side, we have the delta. Now, really quick, going back to the bid and ask footprint chart, what you're going to see is on the left-hand side, we have the bid. On the right-hand side, we have the ask. When I refer to aggressive selling, typically what you're going to see inside of the markets is aggressive sellers are going to come in when somebody executes an aggressive short and they buy at the market or they sell at the market in this situation. What you're going to see is that order is going to be executed here on the bid. On the right hand side, when an order is executed on the ask, that is because somebody aggressively bought the market at that price. So you're using market executions. Now we also have limit orders as well, which we could spot on the DOM here. You guys could see at these prices, we have 27 contracts sitting, 21 contracts sitting, and we also have 20 contracts and then 26 contracts sitting here on the ask. So you have the bid and you have the ask. And again, just to reiterate that, on the left-hand side, we have the bid. The right-hand side, we have the ask. Aggressive selling hits the bid. Aggressive buying hits the ask itself. Now, what this footprint chart actually is, it is a delta footprint chart. So the delta is going to give us the net difference between the buying at the ask and the selling at the bid. So if there's a negative delta of 208 that you guys could see here, that 208 more orders aggressively hit the bid compared to the ask itself. And then you guys could see the positive 234 delta here. That means that there was 234 more aggressive orders that hit the ask compared to the bid, leaving us with a positive delta. And then you can also see that there were 760 contracts traded here and 1,342 contracts traded here. So the left-hand side is going to be volume, right-hand side is going to be the delta. Now, what we also have here is you guys can see this little green highlighted box. What this is going to signify is a buying imbalance, which again, when we think about a breakout, we think about imbalances. I have my imbalance setting right now at 300%. So all that simply means if I'm going to be looking for a buying imbalance, and I'm going to give you guys a random example, what I'm going to be looking for is I'm going to be looking at this diagonally. So if I'm going to be looking for a buying imbalance, I'm going to compare the bid to the ask one price higher. So again, if I were to be looking for a buying imbalance, I'm going to be looking at this 227 and comparing it to the 42. If that is 300% or more orders I came in and hit the ask, then that is going to be an imbalance. Now, what I'd look for is specifically stacked imbalances of at least 2 or more, which you guys can see there was 2 stacked buying imbalances at this price here at 59.80, and I use that to confirm strength, and I use that to confirm breakouts as well. Now, at the bottom of the cluster, you're going to see that there's a positive 70.23, which is going to signify total volume for the cluster. And at the top, this is going to signify total delta for the cluster itself. Now, I look at this to spot possible delta divergence as we see here. Notice how we have a green cluster, meaning a green candlestick, but we had a lot of aggressive selling and price still kept pushing up and up and up. So this is going to be considered delta divergence, which is also why there's a little bit of a green bubble down here to signify delta divergence there as well. There's discrepancies in between the data and price action, which is what I pay attention to on a daily basis. So now that I've actually broken that down for you guys briefly here, which I'm going to make another video going more in depth into all of this and what all of this means and how you could take advantage of that every single day. That's going to be the next YouTube video I post on this channel. I'm going to be breaking down the strategy for you guys and how I use all this information together in between the volume profile and the delta footprint chart to give me the A+ setups that I look for on a daily basis. So before we get into the actual video itself, I want to try and simplify this trading strategy as much as I possibly can for you guys using a whiteboard example. Now, one of the reasons why a lot of my trades, when they hit full TP, I make 5, 6R, 7R, sometimes even up to 8R in a single day in under an hour is simply because of where I'm entering the market, my understanding of correct stop loss placement, and my understanding of correct take profit placement. Those are the most important key elements when looking for these types of setups that are really going to give you a high R multiple in a single day. Like my average stop loss right now is anywhere between 1 to 3 points, depending on where my entry is and if I hesitate on taking the entry or not. Now, what we're looking at here is a volume profile, and we're also going to be paying attention to the high volume nodes here as well, as explained prior. Now, the setup that we're going to be looking for is going to be the complete opposite of the last video, which is going to be a mean reversion setup, which if you guys haven't watched that video just yet, I highly recommend you guys go watch this because this video will only piggyback off of that video. So we're going to be looking for the opposite of a mean reversion setup. A mean reversion setup is when we push too far away from the mean and price is significantly above value or significantly under value, where we could see a reversal back to a mean. A mean being value where we could have a value area low, a high volume node, the POC, or a value area high. So now this black line that you guys see here, I want you guys to think about as price action. This blue line that I want you guys to, that you guys see here, I want you guys to think about as volume by price. And then we have our volume profile levels, our value area low, our point of control is going to be right here in the middle, although it's being blocked, and then our value area high here as well. So you guys could see at this point in time, price was at a value area high and we're trading significantly above value. Now, when we go into each and every day, we're going to allow price action to develop and we're going to allow the volume profile to develop as well. So we could see and identify areas of value and where buyers and sellers are conducting a lot of business. And typically that's going to be not only at the point of control, but other high volume nodes as well, such as this area here. So looking for the complete opposite of a mean reversion, what I'm going to be looking for is for price to pull back into value to then potentially confirm if price will continue in the opposite direction of the pullback. And what I mean by that is you guys could see how much consolidation happened in the market prior to this huge explosive imbalance to move to the upside. And then we had a massive pullback into value, into the POC, into a high volume node. Now, again, the areas that I only look to take this trade setup are at a high volume node or at the point of control where we could look for continuations or technically reversals in the direction of the pullback. So after we saw price push up to the upside, min new highs, the value area high switch, we had the volume profile get really wide here and we saw a big move to the downside back into the point of control and this high volume node. Essentially, what I want to do at this point in time is confirm that we have trapped sellers because I'm looking for buyers to continue to defend this original move that they had and to see if new buyers will come in and push price up. So I'm looking for trapped sellers inside of the markets and I'm looking for absorption and I'm looking for that volume profile to get really wide there again as well. If I can confirm that, and that is confirmed on the footprint charts, and that's when I'm going to actually execute myself into the position. Now, my targets in this situation is going to be the high volume node or a previous value area high. So if, to give you an example, we had a high volume node inside of this area here, where you see the volume profile get really wide, then this would be an area of TP1 and the next area would be TP2. But in this example, we only have a high volume node here and we had a lot of imbalanced transactions going on here, whether it be aggressive buying from the upside or aggressive selling from the downside. So none of these areas and any of these structure points that you may see along the way, either up or down, are going to be areas of take profit for me. Again, I'm going to target different areas of volume. In this situation, I'm going to be targeting this high volume node. That is exactly how I like to trade this trade setup. If I'm taking the trade from a high volume node or from the POC, I'm going to be looking to target another high volume node where we could see a big halt and potentially a reversal. So in this situation, once we've identified all of this trap selling under this area of, or basically at this point of control and at this high volume node, then what I'm going to be looking for is the low of the candlestick. So if we actually print a candlestick that's like this, and the low is right here, and I see all of this trap selling, my stop loss is immediately going to go under the lowest point that we actually saw the market reject if my entry is back above the POC. Now, just to reiterate that, my stop is going to be at an invalidation point that is going to make the trade no longer valid. What's going to make the trade no longer valid? If we have all this trap selling that we can identify on the footprint charts, and then we saw a rejection and a move back up, and my stop loss is going to go under the lowest point where the sellers got trapped before the reversal back up. Now, the entry doesn't really matter all too much where you get into the market as long as the R multiple is still positive. So again, what we're going to be doing before we execute the position is we're going to be identifying our take profit area, which is going to be, again, an area of value, an area where we saw a high volume node actually print. Our area of entry is going to be at another high volume node, and we're simply going to target high volume node to high volume node. So in this situation here, we're looking to enter at the POC where we have this previous high volume node. If we can confirm that there's trap selling here and the buyers are still supporting the market, and then once we can confirm that, then that's when we actually execute on the entry with the stop loss under all of the trap selling, because essentially if we see more selling come into the market and that selling does get rewarded, then that trade is invalid. And lastly, we're going to target the high volume node. So without further ado, let's get right into the charts. All right, guys, now I'm going to give you two examples of this setup and how you can actually identify and execute it every single day. So first and foremost, we actually have the POC. And the one thing want you guys to keep in mind about these examples is that as the volume profile progresses throughout the day, like these levels can significantly change. So there's two main areas within this price action throughout the day that I would have been paying attention to and I would have been very attentive to. And that's going to be one, this POC all the way down here at this 66,009, which we can identify this being the area of most value throughout the day. This is where we've seen a lot of business being conducted and a lot of trading activity going on, which is why it's the point of control of the day. Now, what stands out to me about the POC throughout this day here is if we look at the actual rejections, they're not at the POC, they're slightly under the POC. And what that tells me is as soon as price action started to get beneath these 6,009s, we saw selling activity pick up, but there wasn't enough selling pressure nor selling imbalances to continue to drive the market lower. And we had passive bids or passive buyers sitting inside of this range, absorbing all of that energy and absorbing all of that pressure, which is why we saw the move to the upside. Pullback, same thing happen again, and then the rejection. So most of the times what you guys have to understand is that it's not going to be a picture perfect setup. You're not ever just going to see price, and sometimes it may, but the majority of the times you're not just going to see price come into the high volume node and then immediately bounce and reject after a ton of selling pressure comes in. No, sometimes you're going to see price come slightly beneath or maybe even significantly beneath that high volume node. But again, the whole point is that's the area we're going to be looking to trade. And once we've identified where the selling is coming in on the footprints, that's going to be our area of execution. When people are looking to sell, we're going to be looking to take those longs. And especially in a situation like this, a lot of the times you would have a lot of different breakout traders trying to take this short. Why? Because of the market structure. You see a high, a higher low, a higher high, a higher low at this point here, a lower high, and then price attempting to go down and make a lower low. People will probably be targeting this low and this low, when as order flow traders, we're typically going to be looking to do the opposite. Why? Because we could see where these where these traders are getting trapped. Now, if we go into the footprint charts and we identify what that area overall looks like, that's going to be this entire range right here. This is going to be a 20 tick range bar chart. Now, what I want you guys to identify is, again, the high volume node is going to be in between the 6,009s all the way to roughly about, let's call it the 6,008 or so here, even a little bit lower, but the main level is going to be here, 6,009. There's two ways you can play this. I'm going to go over both ways here as well. So at these 6,009s, where really the POC and the high volume node actually is, you can also see there was a VWAP here at that time. We started to see price get beneath that, and you can actually even see here, I'm going to highlight this for you here again as well. You guys can actually see, I'm going to put this in yellow, all of this aggressive selling under the high volume node and under the point of control. Then what happens shortly after is that we had bids reload into the markets and we had passive buyers absorbing all of this selling pressure. You can see there was a negative 55 delta here and price popped right back up. Now, typically that is not a sign of entry, but what this does show us here is that we do have all of this trap selling inside of this range. And within this range, we identified where really the selling pressure is coming in. That is going to give us essentially a box inside of our box. Now, what I want you guys to visualize is we're going to be looking to take the longs from where the buyers are actually defending the longs. Now, as you guys can see, I have a box here already from the 6,009s is going to be the bare minimum of the box. Now we have the lows being all the way at 6,000 6,005. So ideally, we want our stop loss to be under 6,005. Now, here's the same price action just on TradingView. And what I'm going to do is I'm going to highlight this for you guys. So again, from the 6,009s all the way down to the 6,005s is going to be our entry zone. Why? Because from the 6,009s all the way to roughly about the 6,000 and let's call it the 6,007 and a halfs, we have the high volume node. But underneath that, in between the 6,007 and a halfs to the 6,005s, we have the trapped selling. There's two major differences, right? So the high volume node is going to be the area where we see a lot of business being conducted. But what we see here on the footprint charts in between this 6,008 and a halfs all the way down to the 6,005s is where the sellers are getting trapped. Why? And what I want you guys to really think about here is if we're beneath and we see all of this aggressive selling, we see all of this selling pressure, you guys can see here on volume by price and on the delta, the majority of participants are getting short aggressively, but we see price pop back up. That shows us again signs of absorption. That shows us signs that there's not enough selling pressure to continue to drive the markets down. So what we want is for the buyers to defend that range. So now that we've kind of identified our box inside of the box, what I want you guys to also think about is from an R multiple perspective. If we've already seen the high of day get printed here up into the 6,019s, and we've seen volume come in there from that aggressive sell-off, then that's where I'm going to look to also position myself for in our multiple perspective. So if we're in the situation where we see the trap selling, but our entry is going to be here at 6,009 and our stop is going to be here at 6,005, we could target all the way to the highs up here at 6,019.5, but we're only going to get a 2.5 R multiple. Now, for me, not only do I want to see a second confirmation and another attempt for the sellers to continue to try and drive price down, but I also want to get a lot better of an entry. Now, how can we do that? It's just simply being patient. What I want to do is when I've identified more trapped selling coming into the markets and for the buyers to again defend where those trapped sellers actually are, which if we go back into the footprint, it's going to be in between these 6,007s to these 6,005s. It gives me a more accurate area. So again, I want you guys to think about, I'm going to change the color of this box here too. I'm going to change this to green. What I want you guys to think about is this red box is going to be our high volume node. And then this green box is going to be our area of entry. Our area of entry where we're going to be looking to buy is where the aggressive sellers are getting trapped and their positions are getting absorbed. That's what I want you guys to think about here. I don't want to buy above that. I don't want to buy beneath that. I want to buy inside of that area. Sometimes price may actually go down and push steeper, but then come right back up. But the whole point is for buyers to defend this area. And this is where I want to get into the markets. Now, if we were to actually wait for that and we were to enter, let's call it the top of the box at 6,007, well, their stops slightly beneath at 6,005, we get a so much better R multiple by just slightly being patient. And you also have to be in the mindset of like, you know what? If I'm not going to get my R multiple, then regardless, even if price goes all the way to targets, I would have only made 2 R anyways. I want to put my money at risk where I'm like, you know what? I want to risk $1,000, not to make 2,500 bucks, but to make $4,800, $5,000. That's when the risk is actually worth it to me. And again, I have the same exact stock. So now when price action did come back down, what we can again identify is once we get back in this area, look at how aggressive these sellers are actually executing themselves into the markets here. Now, what I like to do personally myself is I like to watch development with the action itself. I don't immediately, just because I see aggressive selling, take these longs. No, what we're confirming here right now is yes, these sellers are still trying to get aggressive inside of this area. Look at all of this aggressive selling. Next cluster opens up. You can see sellers are starting to get aggressive again. But as soon as this buying starts coming into the markets and there was no reward for this selling and we didn't see that breakout to the downside, we didn't even see price pierce beneath these lows and the buyers defended this area, then that's when I would execute myself into the longs in between and 6.75s all the way up into the 6,007s, which you guys could see gives us an R multiple of just around 6. Let's do 6,007 to be a little bit more conservative here. It gives us an R multiple of just around 4 or in this situation, 6 R with our stops at 6,005. If you want to be a little bit more conservative with the stops, you always could be 6,004. You still get an R multiple of 5, which is why a lot of these trades that I make $20,000, $30,000. Like if you guys go watch my last video that I posted on my second YouTube channel where I literally called out this same setup short and I ended up making $26,000. I only had like 3,500 bucks, $4,000 worth of risk. And that's how I like to trade. Keep my risk small, enter our areas of high quality, and look for those bigger moves inside of the markets with a very small risk portfolio. Now, you're talking about a stop loss was only up to 6,005, 9 ticks. That's not even a whole point inside of the markets. But again, like you're not going to be able to see any of this without using these tools. Now, for the second example, we're going to be looking at this area all the way up here, which is going to be another high volume node, which we can identify inside of the markets. And we can look at the footprint chart, and you can even see how many times we saw buying come into the market, sellers trying to get back into the markets again, they get trapped, and price flushes all the way up. So I'm going to kind of fast forward to this area over here. Now, this area is going to be super important as well. Now, what I want you guys to identify here is, let's go back into ATAS, is not only do we have the volume profile, but you can see how much volume is being transacted in this area: 10,000 orders, 11,000 orders, 9,000 orders, 8,000 orders. So our high volume node realistically is inside of this range here. Now, what I'm going to want to see is if we're struggling and buyers are struggling to break price through these 6,025s all the way up to these 6,026s. The question is, where could we see a pullback to where we've conducted business prior? And that's going to be a few of these areas. We have the 6,011s, we have the 6,009s, and we also have the 6,006s. You know, we could definitely see a pullback into any one of these levels. Why? Because that's where we find value. This is where throughout the entire day, we've seen all of this consolidation inside of the markets. And this is somewhat an example of a mean reversion setup, but at the same time, this is also an example where we're taking a trade at a high volume node. Now, inside of this high volume node, this is where we're going to be looking to execute the market once we've identified absorption and once we've identified trap buying. Now, what I want you guys to look at here is not only the delta by price, but I also want you guys to look at the session delta here as well. Now, these numbers on the right are going to give us an aerial view, almost essentially like almost kind of like a bird's eye view of who's trying to be the aggressor in these situations here, which you could see how much buying is coming into the markets here at 6,025 all the way up into the 6,028. So if we see all of this buying up here, yet we're struggling to break price, yet price is struggling to break through, and we have all of this volume being built up and generated inside this range. I mean, just look at all of this volume that's being traded inside of this area. And what that tells us is, again, passive sellers are now absorbing all of that pressure. And you guys can actually even see it over here. You guys could see how we have a positive delta of 1026. And then we have a complete move in the opposite direction. So we had not only 10,026 orders come into the markets aggressively on buys, we also saw a complete reversal and rejection of that area. And, you know, I'm trying to make things a little bit more simple as much as I possibly can, just simply because I can also get into like the orders that are sitting on the bid, the orders that are sitting on the ask, kind of differentiate whether they're longs or shorts. But in this situation here, look at all of this aggressive buying, then followed up by aggressive selling, and we saw a reversal. So immediately, to me, that's a huge red flag if I'm a buyer. And what I'm going to want to pay attention to is how price reacts throughout this entire range. Now, if we actually look at this and we pay close attention to this, what we can see is we, again, have another push up into this area. Look at how strong this delta is. I mean, this is the strongest delta at this second attempt to go higher since we were at these highs all the way up here, which I'm actually going to grab this. Essentially, what we would want to see inside of this high volume node is for the sellers to defend price under this 20 or under this 60.26 area here, which is also going to be that high of day at that time, especially where all these orders came inside of the markets. Now, what we can see is how aggressive all of the buyers are getting in here. And again, like there's so many different ways you can actually execute on this. Like you can execute it over here. And this is going to be practically the most perfect example of an execution. This is now going to be a 20 tick. We can even bump this all the way up to a 32 tick range footprint chart, and we could see a little bit more clear here as well as to what's going on and really where all the buying is coming in. But I'm going to stay on the 20 tick here, and what you guys can again see is as soon as price is trying to push away from that high volume node, which again, if you look at the last two entry examples, the entries themselves or the confirmation itself that we have those trap buyers or those trap sellers isn't inside of the high volume node itself, but it's either slightly above or slightly under. And with our high volume node pretty much printing all the way to the 26s, then we actually see all of this trapped buying above it. This is where we would be looking to execute off of if we could see passive sellers defend. Now, what that looks like in real time is it would look something like this, where we have price coming up. You could see these deltas start to increase, and you can see these deltas start to build. You can see more aggressive buy orders hitting the ask, and then price comes right back down. And it might be like a little bit of a tug of war where you see price action go up, you see the deltas increase, price comes right down. Same thing. And then that's the perfect sign for you to execute, because that what that tells us is we have more orders reloading on the ask, meaning that we have more passive sellers coming into the markets willing to hold price down at these higher prices. Because again, at this point, like we've gone so far away from the mean that this market can be seen as overvalued as well. And then what we have here is all of this trapped buying. So once we have all of this trapped buying and price starts to reclaim beneath this area, an easy execution would be to wait for aggressive selling to start stepping into the market, showing us that we have sellers coming into the markets, which would be here at this price, which is going to be at 60.25. If you're feeling a little bit more aggressive as prices starting to come beneath the resistance range and we have no reward for any of this buying, then you can execute there. But ideally, what I like to wait for is after we've identified the area that we want to take the trade in and where the trap buying is. The trap buying is going to be up here between the 26s. Even if you would have tried it before, like up here in this area, or over here in this area, over here from these prior areas as well. Like sometimes like your very first entry might not be the right one. But again, as long as the setup is still valid, that's kind of what's more important, because you could have easily taken these sells over here. Price could have came up, stopped you out by maybe a point, and then came right back down. But if that trade is still valid, you can execute on that again 100%. So for me, the entry along this area would be the 20 or the 60.26s, which if we go into trading view and we enter a short position here at the 60.26s and we place our stop at the, let's call it the 60, no, it's a little bit too tight, the 60.28.5, which is going to be slightly above this high. We have about a 10 tick stop. If you, even if you want to go like 15 tick stop, you actually can. But for me, I like to put my stops at a point that's going to completely invalidate the trade, which if price were to start to get above the 2026s and all of this trap buying, we start seeing some reward for this buying now, that would invalidate the trade for me. Then again, I'm going to be looking for a move back down into that previous POC, that previous high volume node, which is going to be here roughly around like the 6,009s is where the high volume node was. And you guys can see with this type of R multiple setup with a little bit of a tighter stop, you have a 6.8 R multiple. And that's the thing, is like sometimes like your very first entry might not be the right entry, might be off on the timing, although you got the greatest confirmation. If the trade is still valid, you can take the trade again 110%, because these are multiple opportunities are crazy. Like 6.8 R within the span of, Crawley says this was about an hour or so, which we can verify. So I was about an hour and 30 minutes to get 6.8 R on that move. And from this move over here from the 6,007s all the way up into the 20s was about an hour and 25 minutes. And this was a very choppy day here as well. So again, I just wanted to break that down for you guys. That's like the beautiful thing about getting into order flow trading, is not only are you going to be able to actually spot all this in real time and not get faked out, because again, imagine how many people are like, oh yeah, you know what, break and retest, I'm going to go long, break and retest or bounce play, I'm going to go long. But then you can't identify all of these trap buyers up here. For me, like that's why I like to kind of almost do the opposite of what the majority of people would actually look at, because especially even all these people that are trying to like long the high of day, I could see the trap buying, that there's no reward for that buying. Even when this large single buyer came into the market at 163 contracts, that got shut down right away. And there were so many entry opportunities here. So it's like, even if you would have gotten stopped out on your first attempt up here, after seeing this rejection, after seeing the absorption, and then sellers defended again, you could have gotten right back in anywhere throughout this range and made all of your money back plus more. And that's really what risk reward in trading is. It's not focusing on like one single trade, but it's focusing on executing high quality setups on a daily basis. Other than that, guys, I'll talk to you in the next one.